Good afternoon. Myself Dr. Gagan Singh. Today the lecture which I am going to discuss with you, that is Introduction to Security Markets. First of all, I welcome all the learners, those who are enrolled in this program of Fundamentals of Financial Inclusion and Cyber Safety. So, various components you will find in this course, and today the topic, as I told you, I am going to discuss in detail, that is about Introduction to Security Markets. So in this lecture we are going to discuss in detail about what do we mean by securities, what is mean by security market, what are the various types of security market, then we have the role and functions of security market, then we will also discuss about the various segments and key participants of security market and how the regulatory framework in security market works, and what are the recent development in security market. Apart from this, we have the benefits of investing in security market, and also we are going to discuss in detail about the risks associated with security markets. So we start with security. One must know about the meaning of security. Basically, securities are tradable financial instruments that represent ownership, a creditor relationship, or the right to ownership. So these three terms are very very important while we are going to study about the security. It is the basically represent the ownership, a creditor relationship, that is through the debt, and we have the ownership, right to ownership, which available with the help of various derivatives. Now, in further, they are issued by the entities. When the question raised who issued these securities, so these are issued by the corporations, governments, and business to raise capital. Basic purpose is to raise capital, and are traded in financial markets. So one must need to financial market where they can trade the securities, and it providing investment opportunity and liquidity. Securities basically facilitate the flow of capital from those with surplus fund, those who have the surplus fund, that is known as investor, to those who need capital, who are the that parties, those who need capital. They may be business house, or it may be governments. These capital funding is essential for economic growth and development. So how it is important for a nation, that it play a very important role in economic growth and development of any nation. So security basically, it is a tradable financial instruments. So basic definition of security means it is a tradable financial instrument that represent ownership is one. It represent a creditor relationship with the help of debt, and or the right to ownership, as I told you, with the help of various derivatives. So this is about the basic meaning of securities. Now the question is, what is security markets? As we know, market is a place in any kind of goods, that where the buyers and sellers meet. So in this sense, security market refers to a marketplace where buyers and sellers trade financial instruments. In place of goods, they trade in financial instruments such as stocks. In stocks we have the equity shares, then we have the bonds. In bond we have the debt securities and derivatives and other investment products. So this is basic definition you can say about the security market. Basically, it is a place, as I told you, where buyers and sellers meet to trade their financial instruments. It plays a crucial role in mobilizing savings and channelizing them into productive investment, thus contributing to economic growth. As in previous slide I discussed with you, that it provides funds by those who have surplus fund through their savings, and provide to those who actually required these funds. So basically, it is a channel for mobilizing saving and mobilizing channelizing them into productive investment. So thus, in this way, it helps in the growth and development of any nation. The picture you can see on your slide, that this is about the various type of securities in slide. So this is about the debt securities, one of them. Then we have the equity securities, then we have the derivative securities, then we have the hybrid securities. So these all types we have covered in the security. Now in detail we are going to discuss about all these types of securities. First one, we have the equity securities. What does it mean? It means represent ownership interest held by shareholder in a corporation. Basically it is ownership interest. For example, you can say the stocks. In other words, we can call it is an investment in an organization's equity stock to become a shareholder of the organization. In equity securities we have the preference share is there, equity share is there, and it represent, basically it shows the ownership of the investment, those who invest the money in the company. Then we have the debt securities. What does it mean? Debt security, basically it is known other name, you can call it fixed income securities, because it provide a fixed income those who provide their funds through debt. It represent borrowed money that must be repaid with term that stipulate the size of the loan. Basically it stipulate the size of loan, interest rate, and the maturity rate when we are going to repay, or the maturity date of these kind of debt securities, in which we can cover, or we can say about the bonds and debentures. They are the example of debt securities. In other words, you can say debt securities are debt instrument such as bonds. For example, a government or municipal bond is there, or a certificate of deposit, that is abbreviation is CD, certificate of deposit, that can be traded between two parties. So this is about the debt security. Basically it is a fixed income securities that represent the borrowed money. Then we have the derivatives. What does it mean? Derivative, basically financial, these are the financial contracts whose value is derived from underlying assets, from where we can take the value of these financial derivatives. We can take the value from the underlying assets such as option and futures. We will also discuss in detail about the option and future. The variable can be assets such as stocks, bonds, currencies, interest rates, market indices, and goods. The main purpose of using derivative is to consider and minimize risk. So this is the basic purpose of any derivatives, to minimize the risk. It is achieved by, how we can achieve this objective? It is achieved by ensuring against price movements, how the price is going on, whether it is increasing trend or it is on decreasing trend. Then we have the creating favorable conditions for speculations and getting access to hard to reach assets for market. With the help of these activities we can achieve the objective of minimize the risk. What are that? These are price movement is there, ensuring against price movements. Then second, we have the creating favorable conditions for speculation. Speculation means where we buying and selling the security with the hope to increase the price in the market. Then we have to getting access to hard to reach though assets, those who are not easily to get. It also provides this facility to the investor. Then last, we have the hybrid securities. Basically, as its name suggests, that combined characteristics of both equity and debt. Convertible debentures, you can say. Many banks and organizations turn to hybrid security to borrow money from investors. This option is also available to the company, or you can say the many banks. From investors, they can also select or choose this option of hybrid security, where the characteristics of debt and equity is available. So these are the main types of securities. In this we have discussed about the equity securities, then we have the debt securities, then we have the derivatives and hybrid securities. As I use the four terms in while we are discussing about the derivatives. These are futures, forwards, option, and swaps. So one must know about these the meaning of these derivatives. So I am going to discuss in detail that what do mean by future. Futures, basically in financial security term, it also called future contracts. As its name suggests, the contract of futures are an agreement between two parties for the purchase and delivery of an asset and agreed upon price at a future date. The date is not decided at present, but the date of the future is decided in case of future derivatives, and it is agreed, both the parties are agreed on an agreed price, and also for the delivery of an assets in on a at a future date. On the other hand, if we talk about the forward option, in forward we have a forward contracts are similar to future. Basically, they are very similar to future, but there is a difference between the future and forward derivatives. But they do not trade on an exchange, only retailing. The basic difference, they do not trade on an exchange, only retailing. When creating a forward contract, the buyer and seller must determine the term, size, and settlement process of the derivative. So this is the basic difference, how it is differentiate from the futures. Then we have the options. Again, options contracts are also similar to a future contract, and as it involves the purchase or sale of an asset between two parties at a predetermined date in a future for a specific price. So this is about the concise definition of option, that options are almost similar to future, but the difference, while we are distinguish these term with futures, then it is also a future based contract, and it involves a purchase or sale of an asset between two parties at a predetermined date in the future for a specific price. The key difference between two types of contract is that with an option, the buyer is not required to complete the action of buying or selling. In this case, the buyer is not required to complete, there is no compulsion of buyer to complete the action of buying and selling. So this is how this term is differentiate from others. Now we have the swaps. What does it mean by, what do mean by swaps? Swaps involve the exchange of one kind of cash flow with another. This is the basic definition of swaps, that it involves the exchange of one kind of cash flow with another. Of with the help of example, we are going to discuss and we are going to explain that an interest rate swap enables a trader to switch to a variable interest rate if they are following some kind of interest rate, and then they wish to or change this interest rate option to a variable interest rate. So this kind of from a fixed interest rate loan or vice versa, you can say. So this option is available only in case of swaps. What is it? Swaps, it involves the exchange of one kind of cash flow with another. So these are the various types of derivatives which we covered under the various types of securities. In derivative, as I told you, four kind of derivatives we have: futures, forwards, option, and swaps. Then you can see on the screen that this is the pictorial view of risk and return for different security. You can see that bonds are at the almost nearest to the O axis, where return is very low and risk is also very low. As the level of the risk increase, the level of return will also increase. In case of equities, you can see that there is a higher risk and higher return, which is the main fundamental principle of any security, that if the risk is higher, definitely the return will be higher, except or in exceptional cases. Then we have the what do mean by role of security market is. Earlier we discussed about what do mean by securities, then we have what do mean by security markets, then we discuss about the various types of security. Now we are going to discuss about the role of security market. Basically, it is a platform for the issuance and trading of financial instruments such as stocks, bond, and derivatives. So this is a definition of security market, and what role they can play: capital formation, economic growth, liquidity provision, price discovery, and risk transfer. So these are the basic role played by securities in the contribution or in the growth and development of any nation. First one is capital formation. Capital formation means invest by those to invest by those in the securities, and from where one can get capital or money as per their requirement, specific requirement of their business. This way they can create the capital formation. Then we have the economic growth. Economic growth means when we invest the money, and that investment goes for any social and economic cause. For example, we invest in the health, education, and any other sector. So this way we can help in the economic growth of any nation. Then liquidity provision means buying and selling of security, convert the security in a monetary term. This way liquidity provision is there. Price discovery means to find out the price, suitable price, or predetermined price. Here we can use what price you are going to opt in the future, where you want to sell your security, at which price you want to sell your security. So this is find out with the help of this security market, that if the buyer is not satisfied with the price, or seller is not satisfied with the price, so this option is only and only provided in the security market. Then we have the risk transfer. When we sell our security to various investor or various buyer, those who need this security in exchange of return, then this way we can transfer the risk to another. Now we are talking about the segments of security markets. First one, we have the primary market, or you can say new issue market. Then another one, we have the secondary market. So firstly we are going to discuss about primary market, basically where the securities are issued for the first time. As in slide you can see that within bracket this is a new issue market, means where we issue the security for the first time, and investors buy securities directly from the issuer. In this case, investors buy their security directly from the issuer. Those who are issuing this security, investor can directly purchase this security from the issuer. For example, through IPO means initial public offering. How does it help? It helps companies to raise fresh capital. This way the company can raise their fresh capital as per his requirement for the growth, for its growth and development. So what are the various key participants in this case of primary market? Then we have in primary market, as I told you, primary market, which is also known as a new issue market. As far as the key participant is concerned, retail investor is there, institutional investor is there. In institutional investor we have the mutual fund or pension fund is there. Then issuers means companies and government, those who issue these securities. Then stock exchange, where buying and selling activity of any security take place. As far as the regulator is concerned, we have the Security Exchange Council and Security Exchange Board of India. Then we have the intermediaries. In this case we have the brokers, dealers, investment banks. So these are the intermediaries in case of key participants of primary markets. Now in detail you can see the issuing company. What does it mean? Issuing company means this is the entity or a company, government, that needs to raise capital and issue new securities like stock, bonds to the public or an institutional investment. They can issue their security to raise capital and issue new securities. Then we have the investment bankers and underwriters. What does it mean? Means the financial institution act as an intermediaries between the issuing company and the investors. They help structures the offering, determine the price, and guarantee the sale of securities even if they don't all get sold to the public. So this role is played by the investment brokers and underwriter, for which they charge the commissions. Then we have the investors. What does it mean? These are the individuals, you can say they may be institutions or funds that purchase the newly issued security in the primary market. Then we have the regulatory bodies. In regulatory bodies, Security Exchange Board, SEBI, these organizations oversee and regulate the primary market. What the main role? To oversee how they are functioning, how they are going to deal in the security market, and also regulate it under the law, and to ensure the trading practices, protect investors and maintain transparency. So these are the basic objective of these regulatory bodies, to ensure the fair trading practices. The practices of trading should be fair, and also protect the interest of the investor and maintain transparency. Then we have as far as the primary market is concerned, companies issue new securities share bond to raise capital for the first time. This is about the primary market. And as I already discussed with you, the key participant, that is the issuers, they may be companies or government, investors may be public and institutions, intermediaries, that is investment bank underwriters, and what is the purpose to issue to the primary market, to raise fresh capital for expansion, project and debt repayment. So these are the basic purpose. In order to raise the fresh capital for expansion, if company want to expand its business, then they need and require fresh capital. Then for various project, to start new project, and also they require these funds for the repayment of debt. As far as the primary market types of issues, first one is the initial public offering, which is known as IPO, first ever public offering. First time when we issue a security, it is through IPO. Follow on public offering, additional new shares, means when we follow on after initial public offering, if we provide further security, that cover under the follow on public offering, when we additional new shares, when we issue additional new share. Then we have the private placement, means to select investment, when we provide this security to the selected investor, that is known as the private placement. Then we have the rights issue, means when we issue or issue the security by any institutions for to its existing shareholder. If a company offering the share only to the existing shareholder, then it is known as the right issue. So these are the very important and important terms in this primary in this security market. IPO, initial public offering, means first ever public offering. Example, you can say the flow with the help of this flow. Company one who issue the security to its primary market through intermediaries to the investor. So this is about the types of issues. Then we have the segments of security market, as it is a vice versa of the primary market. When existing security are traded among investment, when security is already issued and it is again traded by among investment, that is known as the secondary market, or you can say the stock market. This is the place where existing security are traded among investment. As far as example is concerned, NSE, National Stock Exchange, and BSE, that is Bombay Stock Exchange, these are the example of stock market where one can trade within the existing securities. It provides liquidity and price discovery for security. So these are the basic purpose, you can say, in case of secondary market. Now secondary market, security that are originally issued in the primary market and bought and sold among investor, that is known as a secondary market. The company does not get money. In this case, company does not get money. This is clear definitions that investors trade among themselves, because it is already issued by the company, and now the investors, those who have already hold these security, now they sell to the other investors. So trading is within trading among themselves, among the investors. As far as the key participants of secondary market is concerned, again we have the investors, that is buyers and sellers. Stock exchange, we have the NYSE, Nasdaq, NSE, BSE is there. Brokers and dealers are there, because they helps the investor to invest their money in a right and in the right securities. Then we have the clearing corporation is there. These are the main key participant of secondary market. What is the purpose? First one is the provide liquidity. How it provide liquidity? Investor can easily buy and sell security. This way it provide the facility of liquidity. Then we have the price discovery. Market forces determine security prices. So these are the market forces which determine the security prices. This way the price discovery option is there. Then we have the investment opportunities. Investor can trade based on the changing needs. And as far as the types of secondary market is concerned, we have the stock exchange, organized regulated platform. Over the counter OTC market, means less formal, direct dealer to dealer trading is there. Now you can understand this concept with the help of example. Investor A who sells shares on secondary market and to the investor B. So this is basically this is a transaction among the investors. Then these are the key participants in the security market. Issuer is there, investors are there, intermediaries are there, regulators are there. Any regulator organizations that oversees the function of the market, SEBI, you can say in India, Security and Exchange of Board, he look after all the regulations about the market. In intermediaries, we have the brokers, investment bankers, underwriters, portfolio manager, depositories like NSDL and CDSL, National Security Depository Limited, and Central Depository Services Limited. So these about the intermediaries of secondary market. So these are the key participants. In investor, I told you individual, maybe investor, institution, mutual fund, and other. So in issuers company, it may be company or it may be government, that those who issue the securities. So thank you very much for this session.